As the Reserve Bank of India's MPC meeting unfolds, speculation rise about potential measures to address the liquidity deficit in the banking system. Among the key expectations is a cut in the cash reserve ratio, a move that could significantly impact banks and the broader economy. The cash reserve ratio is the percentage of banks' total deposits that it must hold in reserve either in its own vaults or with the RBI. This regulatory requirement helps ensure the stability and solvency of the banking system by limiting the amount of funds banks can lend. India's banking system is currently facing a liquidity deficit, as reflected in rising interbank lending rates and constrained credit flow. While the MPC is unlikely to announce a repo rate cut in its December meeting, analysts believe that lowering the CRR could be a more immediate and effective measure. Analysts highlight that a 50 basis point cut in CRR would infuse approximately 1.2 lakh crore rupees into the banking system, easing liquidity pressures. With interbank lending rates at 6.7%, which is higher than the repo rate, banks are struggling to meet demand for credit. Madhavi Arora of MK Global noted that CRR remains higher than pre-COVID levels, making it a prime candidate for reduction to enhance liquidity without requiring a MPC vote. A CRR cut would increase the money banks can lend, supporting sectors like small and medium enterprises that are crucial for economic recovery. ICICI Bank's B. Prasanna explained that cutting CRR enables banks to lend more efficiently, particularly to underserved sectors. The focus shifts from rate adjustments to ensuring sufficient liquidity in the system. With inflationary pressures easing and growth remaining a priority, a CRR cut aligns with the RBI's pivot toward a growth-supportive stance. Brokerage firms such as Morgan Stanley and BofA Securities anticipate measures like CRR reduction to ensure ample credit flow and boost economic activity. A CRR reduction frees up funds for banks, enhancing their ability to generate revenue through lending. Citi analysts noted that public sector banks like Punjab National Bank, State Bank of India, and Bank of Baroda would see largest benefits in terms of NII. Among private lenders, Federal Bank, HDFC Bank, and Axis Bank stand to gain significantly. Stocks of public sector banks such as UCO Bank and Central Bank of India have already rallied in anticipation of a CRR cut, with the Nifty PSU Bank Index up by about 1%. Analysts believe these banks would benefit the most from increased lending capacity. While a repo rate cut remains unlikely until February, experts expect the RBI to take dovish measures, signaling support for growth through liquidity-enhancing tools like CRR cuts or open market operations. This dual focus on liquidity and growth is seen as critical for sustaining the economic recovery and maintaining financial stability. A CRR cut, even in installments, would provide immediate relief to banks while ensuring credit continues to flow to key sectors, setting the stage for a more stable and robust economic environment.